FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
This episode of the Financial Survival Network is brought to you in part by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of over 185 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the New York Stock Exchange American as SAND.
The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's 10/3/18. Well, this year is rapidly coming to a close, and a trend in motion stays in motion until it doesn't anymore, kind of like the planets revolving around the sun until an asteroid crashes into a planet and kind of knocks it off its orbit. Maybe the stock market is very similar. Hey, as always, be a part of the show and send us your emails, kl@kerrylutz.com. Well, talking about trends, talking about markets, etc. Well, Danielle Park is with us again, jugglingdynamite.com. Danielle, you wrote a really interesting article that everybody is an ETF investor, even if they don't know what ETFs mean. What the abbreviation, I can't remember. It's not,
Exchange traded funds, you mean? Or?
Yeah, ETFs, right.
Yeah.
But
yeah.
the abbreviation there, it's not, what do you call it, that the thing spells a word like NASA or that. Anyways, enough of that. So ETFs, exchange traded funds. It's all the rage, and it's been a trend that's been picking up since the early 2000s. As you wrote, what can go wrong?
Yeah, well, I wrote that article inspired off of a podcast that Lance Roberts just did of Clarity Financial, and he's looking at the trends, the flows that have been going into exchange traded funds over the last 20 years, and why the beast has really evolved into something that it didn't begin as. And that really prompted me to remember that in the late 90s, when ETFs were just getting started, I mean, everyone knew the SPY, the one that was based on the S&P 500. That was essentially the first one to get going in the late 90s. And then the idea of, having a low-cost basket, one and done efficient exposure. You could put in, the S&P 500 without having to buy all 500 companies. And, this whole thing seemed like a great idea from inception in terms of keeping costs low, very efficient, very easy for individual portfolios to have, diversity without having to go through all the costs and work of rebalancing and all that sort of thing. So in our practice, we certainly saw ETFs as a great product from the beginning and started using them. Now, fast forward 20 years later, and what we've got is a good idea gone wrong, because you have, Wall Street and Bay Street and all the financial sector seeing this as a great product. They love products you can scale, right? Products you can scale are their dream come true, because they can just sort of pick a wrapper, present it to the public and sell the hell out of it, right? So that's really what's happened. And then as we've had these long extended periods of rising markets like we have since the, off and on since 2009, when this particular cycle got underway, the QEs, floating world markets all ensemble, you really had people feeling like stock picking was irrelevant and you really just needed to be in the market. And that was a self-fulfilling prophecy, because as most managers are benchmarked to one of these indices, they typically just replicate it. Even if they're so-called active managers, they just replicate the index. So you've got ETFs, exchange traded funds, that are made to mimic the index or have the same components as the index. And then you've got managers who are all benchmarked to the index. And it's this idea that, you just have to constantly buy and hold these things. And what's happened, of course, is that I say that it's a great idea in inception, but you have to always be aware of what it is that you're holding. And in the process, the quality of it has degraded significantly because as we were talking about before, the number of publicly traded firms since in the last 20 years has halved because of mergers and acquisitions, because of things going private equity, things being taken offline, merged into larger and larger conglomerates, which has been a key theme. And so you really have less components in more and more flashy wrappers or marketing packaging. So it looks like there's all this diversity, that you can construct portfolios with all this different ETFs or funds, but ultimately they're all passive. They're all tracking the same thing, and they're all holding the same shrinking pool of companies themselves. At the same time that you've got huge correlation. You have huge correlation because you've got everyone basically doing the same thing all over the world with huge leverage, especially over the last 10 years. The highest margin ever on record, for example.
Right.
Derivatives exposure, everything based off of these indices and products, these exchange-traded funds. So you've really got kind of a toxic brew now. What started out as a low-cost way to participate in a diverse basket of companies has now become a highly concentrated, risk-exposed way to have enormous leverage and to face the risk of all the overvaluations that now plague markets all over the world.
Hey, it's so true. And let's not forget also Sarbanes Oxley cut off the flow of companies going public because of all of its purported anti-fraud aspects. It wound up really stopping young up-and-coming companies from going public. And
or sending them to places like Britain where all the rats went off the ship and they didn't have to sign, for example, attest to the veracity of financial statements there to the same degree that you did in the U.S. I was actually highly in favor of that. I thought it was very important. And we've talked about connecting personal culpability of executives to the information that they put out to the public to influence the public's purchase of their shares. And I think it's highly important that they can't profess not to know, the contents of their financial documents, which are being issued to the public. And that's, in fact, what happened. So I thought that was huge. But you're right. It was one of the catalysts for why companies then went to places where they didn't have that kind of personal accountability for the information.
Well, it just wasn't just a question of accountability. It dramatically raised the regulatory costs, all these certifications that had to be done, and it just really put up almost insurmountable roadblocks for many small companies where they'd say, hey, I got to be nuts to do this because I'm going to lose 10% of the money I was going to raise in regulatory costs. Plus, I got their recurring regulatory cost. It was enough to sink some companies, and they just decided we don't need to do it. And if there were ways to get out, they did, or otherwise they sought private solutions, right? And
so it's a combination of things for sure. But the nub of the matter is really that the pendulum's really gone from, we humans are inherently lazy intellectually, it seems. And if we can pick something that is simple or glossed over or the one and done idea, then we tend to just do that and not think any further. And that's really become the undoing of us because, like I look at portfolios all the time from people who are not clients of our firm, and they'll have, a bunch of different pools, ETFs or passive funds or supposed active funds. It really doesn't matter what the label is because when you look inside, they're all holding the same stocks and sectors, replicating the same indices, and a huge overlap of the top 10 holdings in many of them. So, the Amazons and Apples of the world that have been driving the S&P 500 and the NASDAQ, especially in the last year, to, new marginal highs while the rest of the world is rolled over, while the bulk of the stocks under the headlines are, many of them have already entered bear markets. We haven't had this kind of, under the cloak of new marginal highs, you've got a lot of disintegration underneath. And if people are just looking at the wrapper and thinking, oh, look, it's still going up, they're not paying attention to the constituents and the risk inside. And that's when the horror begins, because let's not forget, if everyone's been buying the same things on the way up, they will also have to sell the same things when redemption requests accelerate.
Yeah.
And that's what brings the downward pressure. And that's what that, Lance Roberts is really underlining, is the risk there that, if everybody's on the same side of the trade, and they are to the tune of trillions of dollars, then that's the very same pendulum that swings back to force the selling of the exact same names all at the same time. So people are thinking, oh, well, if I'm not too worried because I'm holding the basket. And that's really a moniker for going to sleep at the switch.
Very, very true. And, it's we used to talk, once upon a time when the market was advancing or declining, we talked about breadth of the advance, right? Nobody talks about breadth of the advance anymore, do you?
Well, except to point out that it's got really bad breadth, as my partner Corey likes to make jokes about all the time. But it's the internals of the thing have not been this bad. Well, maybe actually ever really. Even if you look at the Dow, every time the market's closed at a 52-week high in the last 52 years, when most of the NYC had already dropped by 20%, the majority of the stocks in the NYC had already entered a bear market and were below their 200-day moving average. When you have that coupled with the Dow at a 52-week high, you've had 3 incidents of that. 2 other periods since the late 1990s.
Always ends badly.
And they were 2000, 2007, and today. So, it just, again, it's not any kind of magical anything. It's just the revelation that everyone's holding the same things. Everyone's convinced that they can only go higher, just like, real estate in 2006. It can only go up, so we're not worried, and we're long term. And, of course, it's hilarious and tragic, because the fact is that no one's long term when the thing starts crashing. Very few people will hold through the downturn. And even the ones who think they are long term and they're not going to sell, they get creamed because everyone around them is levered and selling in panic.
Hey, what did they say? The first time around is tragedy. The second time around is farce. What does that make the 4th and 5th and 10th time? Is that just pure human stupidity and intractability?
Well, and I always like to say, you're running out of runway, folks. How old do we get to go in this life, any of us? How much time do we have to keep experiencing these things and having to wait years to recover our losses? And that's why this approach is inherently flawed. In practice, a buy and hold may work, and people show you 40 and 50-year charts. In real life, it's usually a disaster, especially when you're in, as I say, the most overvalued, overlevered periods in history like today.
No, so true. Couldn't have said it better myself, Danielle. So, hey, we were talking about, polling and how it's become a substitute for news, a way to manipulate people, propagandistic endeavors, astroturfing, as they like to call it. Why are we living in this poll-driven world? And there's a poll for everything. There really is. Like, you look around and you see they just keep polling and polling. And, what is the point of all this is what I'd like to know.
Well, I think it's information manipulation of every kind, right? Every single thing that comes at us. I don't know about you, but I recently, for example, had to get a new phone. And as I'm setting up my phone, in the wake of all this revelation about the Facebooks and the Googles and everyone abusing our information and selling it up the river, now they've all got these consents. They make us click, we consent to this, we consent to that. I must have clicked about 100 consents
you had
to
no
sell
idea
everything, including my first grandchildren, I'm sure.
Yeah.
But you're in such misery trying to get your thing back online so you can get back to work and not have interruption that you go, okay. And I'm like clicking, yes. You're accepting the terms, and the terms are 10 pages long per incident. Like it's, you talk about farce. This is farce, right? So basically every single thing now is a way to capture and sell information, to act as a way to persuade others of a particular point of view, or encourage them into seeing their way to buy a certain product or idea. And so it's highly manipulated, all around us. But I would have to say, a friend of mine was saying the other day that he was feeling low because he said he thinks, things are so off the path, or are so broken, or so messed up. And I said, you know what? I think in fairness, we would have to say that they can't be the most messed up they've ever been. Like, I think it's strictly that we are more aware. We are inundated nonstop by media and news, information that comes at us all day long, whether we're driving in a car, whether we're sitting anywhere, and we, because of that, we have a perception that things have never been worse. But ultimately, that can't be true. If you think about all the different horrendous events that have happened in human history, we certainly have lots that can go wrong today, but we also have more things going right, arguably, than we've had in humanity as well. So I think it's a bit of, you have to be very careful and skeptical of the things that you're being told on a daily basis. Back to intellectual laziness, I think we have to work harder to get to the bottom of things, to understand the mechanics of things. The more we put our mind on autopilot and just let other people do all the heavy lifting and thinking and serving us the morsels, I think the more, ignorant and endangered we are.
So true. I mean, I couldn't have said it better myself, Danielle. It's so much just garbage that we're just inundated with. And so many of the of people, like, they're so serious about it. When there's a new poll, regardless of what it's about, it's irrelevant what the poll's about, in my opinion, because they're all cooked. And that's why I personally starting calling October as National Lie to Your Pollster Month, because at least if we lie to them, then they'll become completely irrelevant, inaccurate, and have no influence. And then hopefully the media will stop doing them, because that's really the key, is we need to get rid of them altogether. There's really no purpose for polling other than manipulation and propagandistic purposes. It serves no other purpose whatsoever. Yeah,
well, could be, but I don't think they're going to stop. I think people, I get a lot of...
If we all lie to them?
Even service providers, that I use for various things with our company, they're constantly asking me to do surveys, and I really hate doing surveys. I will send my comments, but these, tick this box from a 1 to 10, this, that, and the other thing, I really try and avoid doing those because I find them a complete waste of time. And ultimately, they're wanting you to affirm a certain worldview. It's not like no one wants to actually read and process your individual commentary. They want to know how it fits within this box or that box so a machine can read it, Carrie, because they don't want any complexity that a machine can't grade as yes or no.
Yeah. Isn't it amazing? And then, like, the only surveys that I fill out are sometimes at the car dealer, because those guys are actually compensated on the basis of your survey. You're at, a decent, at higher end car dealers, but now all of them, it's all the same. And they're all pretty much compensated on the basis of positive feedback.
And sales and servicing. Oh, yeah. Servicing is the huge thing, right? So they're always trying to get you in for the next servicing, because that's the whole real meat of the model.
That's the profit in the dealership is servicing, So very true. I mean, it's shocking.
Yeah. So really it goes back to, if there's a theme here, it's about the need to keep your sales separate from your service side, because as everyone experiences, when they do get their car looked at in a major dealership that they know makes their profit from their repairs and maintenance and parts.
That's all they make money on.
And they get a recommendation that they need a full this brake job, full that job, whatever replaced. You're always thinking to yourself, like, I want to trust you, but on the other hand, this is where your profit margin is, and maybe I should have an independent mechanic look at it, see someone who's not in the business of selling me the parts. And find out if they agree with your assessment. And, that's my number one statement always about financial services. As you well know, Carrie, we live in a world primarily populated by people selling products, whether it's ETFs or whatever else it is. And the problem is those are the people that are also, supposedly advising governments and families and companies on all things financial. And therein lies the disaster of our times. So, Nassim Taleb, I've mentioned this recently somewhere else, but I'm reading his latest book, Skin in the Game. And in it, he says in one quote that, as a trader working in institutions, they had a code of ethics where you don't screw other traders over, basically, because they're going to know and they're going to call baloney on you and they're not going to do deals with you.
And they'll get you back. They will screw you back. So it's easier just not to. So there's an
undisclosed sort of rule or code of ethics when it comes to traders. But he says there's no such code of ethics when it comes to outsiders, customers, people buying products from these firms. And he says, the reality is that they're the dupes. They're the dupes of the trades. That means all of us who are consuming financial products are the dupes. So we go back to, you can't afford to rely on other people's research, other people's assessments, other people's recommendations. You need someone who's unbiased doing individual assessment. And his quote is, he says, so giving advice as a sales pitch is fundamentally unethical. Selling cannot be deemed advice. We can settle safely on that. You can give advice or you can sell it by advertising the quality of the product, but the two need to be kept separate. Full stop.
Perfect.
So, there is the next sort of business that must be addressed in the whole financial world. And I noticed Bernie Sanders put forward a bill recently, I think today, talking about a formula for how one can break up the largest institutions if they have, I believe it's 3 or 4% market cap of GDP as an example. So that would catch all of the Wells Fargos and the, even Berkshire Hathaway actually. But
what about Google? It probably would get Google and getting close to Facebook as well, right?
Yeah, and I think this is critical. I mean, I've been writing about this for some time. We're due for a trust busting phase. These monopolies have become, unduly concentrated and powerful, both in political terms, both in the money they can spend to sway human minds. Yeah. And it's not constructive for anything productive in the longer run.
Oh, for sure. I mean, truer words, Danielle, never spoken. Hey, you just look and you see what's happening and you just shake your head. Do you remember, I think it was during the LIBOR investigation or some hearings or something, where when they were talking about their clients, the way that they referred to them was obscene. They were basically like, I don't even remember some of the terms. They were horrible. They were foul, vulgar, obscene, but basically that they were dupes and suckers, and everybody's happy. Everybody's happy with that.
Dennis Kellerman of Better Markets, he's the CEO of Better Markets, which is, he puts out some really good stuff. But one of the things that he wrote last week was just an article saying, hey, remember, Goldman Sachs failed 10 years ago today. And people would read that and go, wait, not Goldman Sachs. You mean Lehman? No, Goldman Sachs. Yeah. Get it straight. All of those institutions took a massive amount of help and lifeline from the central bank and from the American taxpayers in order to stay afloat. And that was the truth that was hidden obfuscated with all this talk about the Lehman failure and the Lehman failure. The Canadian banks, too, they took a huge amount of support from the Canadian taxpayer, and yet they barely even mention it as a footnote now because they were bailed out, saved, rescued, lived to sell another day. And, we're now living with the weight of all the mess that they have compounded since. So
they all failed. Even American Express, before the financial crisis, American Express they had a credit card division that they always managed to lose a lot of money on. But their card, you charged it, it was due that month, you maybe got a grace period, but they didn't print money. Now, American Express is a commercial bank, and every time you use your American Express card, you're increasing the money supply. All these things happen, unintended consequences, really bad, because they have little incentive to control the size of their portfolio and the risk now, because they've been bailed out once big time for, I think, $7 billion. $5 to $7 billion sticks in my brain. All of these big players, hey, no wonder they consider their customers suckers. I mean, wouldn't you? I mean, if it's like taking candy from a baby, if you don't have ethics and you don't have limitations on, your predatory instincts, then you become one of them.
Well, and goes back to corporate executives using the announcement of their buybacks to liquidate their personal holdings into the strength, and that's another article that I was writing about this week because the amount of 2018 has seen a record amount of buybacks, but it's also seen a record amount of executives cashing out, and the SEC has been mandated by the Senate in the U.S. to do investigate this, which is laughable because it's so obvious. Yeah. And, it shouldn't be allowed. We need some new rules in the mix that just are not complex, that are dead simple and straight, and just say you shall not be able to do this, full stop. And you have to have greater disclosure. So, and buybacks have to be terminated because they're caustic, toxic. They're just market manipulation of another color. And it's just, it's really clear to me that I think the pressure's building. You talk about the awareness. I'd say one of the good things perhaps of the internet and the access to alternative outlets of information is that people are slowly sort of connecting dots and coming to a different sort of perception of what went on in 2008 and why we have problems still that persist and how risks have built against the average person and average worker and investor again. So I'm really hopeful, and I know it may be naive, but I am really hopeful that the next blow up, people will have less tolerance or, complacency around letting these same companies keep abusing and using us this way.
Oh, it's so totally true. Hey, you know what? Having these guys self-regulate, Danielle, is like asking the drug cartels or letting the drug cartels self-regulate. It's the same exact thing. And as
soon as you have too big to fail out of the mix, you can't have a self-correcting mechanism, and it doesn't work, because if you're saying that these firms are too big to fail, then they are inherently working with a net that other small companies and the rest of us in life don't get, which is we can, if we screw up, we hurt, we lose, we suffer, we go down. When you're too big to fail, you screw up, you are bailed out. Hey. And therein lies why we don't have any self-correction, why we don't have any capitalism or accountability. Right there is the nub of it.
Hey, look, if you have a business without the fear of bankruptcy, then it's pretty much like religion without the devil. And, there's nothing to keep you honest if you don't have a potential to fail. And multiply that, the big banks on steroids and other large corporations, which no doubt when the next debacle hits, they will be deemed too big to fail as well, and they will receive bailouts, whether it's Google or Apple or, we already know General Motors, they were too big to fail, and so is Chrysler, although now it's Fiat. Hey, all these things. Anyway, Danielle, we got to wrap it up, but as always, thanks for coming on. JugglingDynamite.com. Go check it out. Danielle's original articles, very incisive, in-depth things you need to know about. And Danielle, we'll talk to you in a couple of weeks. Be well.
Thank you, Gary.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.